Hi guys, welcome to T Accounts. In this video we will cover inventory, chapter 6 F3 ACCA. Inventories are actually assets held for sale in the normal course of business. If you have for instance general store, whatever, washing materials, breads, jams, whatever you are selling in routine, that's your inventory. Same way, if you have a shop for home appliances, any washing machines, refrigerators, microwave ovens, whatever you have there in your stock, that's your inventory, what you are selling in routine. So for trader, this is simple. Whatever they are selling and buying, that's their inventory. Assets held for sale in the normal course of business. If for a manufacturer, they are doing different process, so they may be having at the end of the year inventory in different forms at different stages of production. So normally these are goods for goods purchased for resale, normal for trading. For manufacturers, it may be in different forms like raw materials, consumables. If they use oil, like furniture makers, furniture producers, they may have different polishes or you can say glues, stitching material, things like that. So consumables, partly finished goods. At the year end closing date, you have manufactured some furniture or whatever you are making, but some of them is not completely finished. That is partly finished. For instance, you have arms and legs of chairs and tables ready. You need to do the further process on that to make them finished good. Then you have finished goods, inventories that are ready to be sold. You don't need to do anything, finished goods. So it may be in different forms. That is broad definition. We'll discuss that those things in detail, but this is what we'll cover in this video, in this chapter actually. I've written all this to save time, because during the video if I write these things it takes time and it doesn't write that bold if I write too fast. So inventory, we have year-end adjustments for opening inventory, closing inventory, valuation as per International Accounting Standard 2. We need to value it. Normally we value it on cost, but standard says value it on the lower of cost or NRV. In abnormal, non-routine circumstances, sometimes your inventories fall below NRV. NRV falls below cost. So you need to value it on that. We'll discuss how to calculate NRV and cost, but first we'll deal with this practical part first. The things that can be asked, tested in the exam. I'll focus more on those things. What are these adjustments? Normally during the year we don't pass any entries in the inventory ledger. For instance, if inventory ledger is like this, we'll have opening balance only. Brought forward, whatever it is. We do not touch it, don't pass any transactions, entries during the year. Only at the end of the year, at the closing time, we pass 2 entries. Opening, all this is details are given in your book as well. Opening inventories. Why is it not writing that bold? Opening inventories, we transfer that cost to the cost of sales. Cost of sales to inventory. This inventory is opening inventory. So this is transferred to cost of sales. Then closing, Closing inventory. Closing inventory is removed from the cost of sale. We'll discuss it in detail, but high level idea. It is removed from the cost of sales through this entry. Inventory to cost of sales. Opposite, reversal of the first entry, but with the value of closing stock, a closing inventory. Okay, so these are the two entries passed. Now, to understand it better, actually I have an example. I'll borrow the data from that example, that information. I'll use it to explain this concept. It is test your understanding 2 on page 94. I'll read it for you. Actually, I have already noted down the important information from that to save your time, but I'll read it for you so that you can follow me. Peter buys and sells washing machines. He has been trading for many years. On 1st January, his opening inventory is 30 washing machines which cost 9,500. So I noted opening inventory 9,500. He purchased 65 machines in the year amounting to dollars 150,000. Purchases $150,000. Then closing inventory. He says on 31st December 2017, he has 25 machines left in the inventory with a cost of $7,500. Closing inventory $7,500. And what about his sales? Peter has sold 70 machines with a sales value of 215,000 in the year. So sales value is 215,000. So they are asking for to calculate the gross profit for the year ended 31st December 2017. Now we'll learn that as well, but I wanted to explain these entries first. So, for instance, it says opening inventory in this example on page 94. Opening inventory is 9,500. So, the inventory ledger will show this $9,500 opening. No other adjustment till the year end. Then we'll pass this entry and that entry. And when we pass this entry, like to transfer it to cost of sales, we'll prepare the cost of sales ledger as well. This is for your understanding only, otherwise they are not asking for this and you don't need it. But understanding is very important. Because when I say removed from the cost of sales, you need to understand what I'm talking about. Now, when we passed first entry, we transferred this opening cost to cost of sales. How? We said cost of sales debit. How much? 9,500. And inventories credit, inventory account or whatever you call it, 9,500. Now what happened is you transferred this from here to the cost of sales, and you will say cost of sales account, meaning transferred it to 9,500. So cleared this account. It will come here like opening inventory in 9,500. Now it is in the cost of sales. Okay. What else comes in the cost of sales? You need to prepare that. Purchases. Purchases are added to the cost of sales. 150,000 it is said in that example. Okay. Now you have this. Now this is closing inventory is removed from. Till now we have charged everything to the cost of sales. See, inventory opening, whatever we purchased, it's in the cost of sales. So cost of sales is overstated. So to apply the matching concept, because we have some purchases here, some inventory here which we haven't sold, but we are charging that cost to this year's revenue. This year's revenue should be matched against the cost of the sales only, the sales you made in this year. So if you haven't sold some of the inventories, it means that cost cannot be charged to this revenue that will be sold next year. So the revenue related to that inventory will come in the next year. So this is a bit difficult, but you will understand with the passage of time. But this is high level idea why we pass these entries. Now at the year end you will calculate the final value of closing inventory and you will pass this entry. Inventory to cost of sales. Thanks to this example, we have closing inventory here. We don't need to calculate. $7,500. $7,500. Okay. Now, what we have actually done with this entry is we have removed this closing inventory from this by saying inventory 7,500. Removed it and it came here from cost of sales 7,000. Now this is our asset that will show in statement of financial position. It will be carried down balance as well. Carried forward, let's say, balance that is presented in the current assets in the financial position. How much it will be? It will be 7,500. We have already learned how to balance the ledgers and get the balance. So that will appear in our financial position. Now, what is the cost? Cost of sales. Now, by crediting this cost of sales account through this entry, we have reduced the cost of sale, removed it from the cost of sales. How much it is? If we add that 150,000, 59,500, 159,500. 159,500. Hope you can read it. So this will go to profit and loss account. What is the balance? 152,000. That is our cost of sale, the amount that will go to profit and loss account and charge to profit and loss account. So these are the entries, how we do it. But this is for concept purposes. When I say removed from the cost of sale, added to cost of sales, these ledgers, T accounts, explain it very clearly and you can easily understand it. But for exam purposes or for test purposes, they will not. They may ask, but normally what they do, they ask for statement, vertical statement of profit and loss account or to calculation of gross profit. That will be the same thing. You will I didn't want to remove it, but I think I need more space for that. Same example, they are asking for gross profit. For gross profit, we need sales first. They have given that information. I'll try to be as bold as possible. Okay. Sales. Now we know how to calculate cost of sales, but that was in T account. Here in the statement form, first opening inventory. That is 9,500. 9,500. We'll add purchases. Opening inventory plus purchases. How much? $150,000. Okay. Now this is total cost. Total cost. But it includes something which we need to remove. That is still in inventory. The things which are still in inventory from opening, maybe from opening stock and from purchases, that inventory we need to remove. We say closing, less closing inventory. 7,500. When we mark like this, it means we are deducting it, minus. Total cost of sale we calculated already, it's 150,000. Cost of sales. If you deduct it from the sales, you will get gross profit. So that's your gross profit, how we calculate gross profit. But basically we are concerned with inventory because that's our topic. Opening and closing adjustments, that it's key part of cost of sales, and risky as well, because if you increase this amount, overstate closing inventory, more gross profit, bonus. So it's a bit risky area. That's why they are giving so much guidance how to value this, and monitored as well, tested by the auditors. Closing inventory is counted and valued by them. They try to basically make sure it's not overstated or understated, fairly stated. It should be fairly stated. So that's why it becomes very important. Now we'll move to valuation part. Valuation, here standard says value inventory at the lower of cost or NRV, whichever is lower. Normally NRV is simple. Net realizable value is from this side. Net realizable value. It is expected revenue. If you sell an item of inventory, what are you going to get? Expected revenue from sale. I don't go into detail. This minus any further costs. Further costs to sell, to make the sale. Why we need this net realizable value, sometimes what happens is your inventories fall below your cost. Maybe they are damaged, obsolete, sitting in the stock for a long time, or some invention in the market has rendered them worth less than their actual cost. So we cannot overstate it. Prudence concept, conservatism tells us that we recognize all the anticipated losses. So when there are some indications that we have loss in the inventory, we need to book it, recognize it. So if we know that this is we cannot sell it on the cost and we still keep it on the cost, it means there are some losses which we are not recognizing. So that's why the standard says if NRV, net realizable value, is less than the cost, then state that inventory on this value. So if you deduct it from here, you will get NRV. Meaning if you need you have some product which is say damaged, you need some repair and maintenance work before you can sell it, or you have something obsolete, you can sell it, you don't need to throw it away, but you can sell it, but you need some further selling expenses like marketing or commission or something like that. You will deduct it from here and you will get the net realizable value and value it on that. Whereas cost is concerned, in cost you can have standard gives all this detail and it is written in the book. In cost you can add the cost of purchase of inventory. Then if you are say a manufacturer, you may have direct labor, direct material. If you are doing some process on the product or raw material you purchased, then you may have a conversion cost like factory overheads, factory depreciation, supervisor cost, things like that. May have freight in, you need to pay the transportation, handling. All these things are acceptable and recognizable costs. Now there are things that you cannot recognize, clearly excluded items. In question they will give you that information as well, just to confuse you and check whether you know, whether you can have the knowledge what you can add or what you cannot add. So exclusions are, it says you cannot add administrative overheads like supervisor, factory supervisor salaries. You can give factory overheads but not administrative overheads. Then if you have some selling expenses, can never be added. The discussion of NRV is different from this, but here you cannot add any selling expenses. Then what else you can have? Selling expenses, storage expenses. You have your inventories, you need to spend on the storage, big cost, but you cannot add it to their cost. That is not something which is adding value to your stock, that is just routine expenses. Then abnormal wastage. For instance, if you can produce, your capacity is to produce 1000 units of something, and you are producing, for some reason you produce only 10 units, so you cannot charge all the depreciation and this labor, all this to only those 10 units. It will be highly overstated and not acceptable. You cannot sell it. So only normal capacity and normal, you can say, costs. So excluded, these are the costs that you can include and the things that you can not include. Now moving on to the methods, how to do that. They have a good example here, and through that example we'll do all the methods. Basically there are 3 methods that we'll be going through for cost. Methods for cost calculation. Unit method, then FIFO. Unit method, let me write the other as well. Then we have average cost. In average we have further you can say periodic average method and continuous. Now unit method. Unit method is where inventories are clearly distinguishable, identifiable, and you can easily recognize which units are there and at what cost they were purchased. Just see their labels and add them and see, okay, this is closing inventory. You can apply that unit cost over there. FIFO is where you have a big pool of inventories, cannot be identified like unit cost. So you have a pool from which you are using the inventories, selling it or using for manufacturing. It says the basic assumption in FIFO, what is the form, full form? First in, first out. Okay, so inventories bought first will be used or sold first. That is the assumption. At the year end, whatever you have, that is from the most recent purchases, acquisitions. That is the assumption in this FIFO method. So we'll do that through an example. Average cost, weighted average cost, periodic. Throughout the year, you keep on purchasing inventory at different rates. At the year end, you add up all the costs and divide it by the quantity, and whatever is the result is the rate per unit of your inventory. Continuous, same thing but little bit different. This is calculated when you have all the purchases, data for all the purchases during the year and the total quantity. Then you can calculate periodic average. But continuous is after each transaction you update the rate. After each transaction, whenever you purchase, further purchase happens, you update the rate by adding the new quantity and the value of that quantity. We'll understand that better through an example. So these are the methods that we'll be doing through this example. And example is, now guys, I have noted down a data from an illustration on page 104. We'll go through this, use this data to do all the three methods which they are asking in this example, and it will be very helpful to understand the concept. So I'll just read it for you. Invicta has closing inventory of 5 units at a cost of 3.5 per unit at 31st December 2015, and they are asking for the calculation of 2016, first week of 2016. So the 5 units they have at the closing of 15 is our opening stock. That's why I wrote opening on 1st January 5 units at $3.5 to make it easy for you, because I noted down the important information. Then during the first week of January 2016, Invicta entered into the following transactions. On 2nd January, she purchased 5 units at $4 per unit. On 4th January, again she purchased 5 units at $5. 6th January, she purchased 5 units at $5.5. And on 5th, they are also giving information for sales, but for the cost we don't need using these methods and calculation valuation of stock, we don't need that information about their sales. But they are saying Invicta sold 7 units at $10 per unit on 5th January. We need it for you can say profit and loss account. They are asking for that statement in the second part. So we'll go through this example very quickly to understand different methods. FIFO, first using the FIFO method. Now FIFO says basic assumption is the business will use the oldest purchases first, oldest stock first for sale or manufacturing. Now we are calculating the closing stock and the valuation of closing stock, closing inventory. Now total units, how much? Opening stock was 5 units, then she purchased 15 units, 15 plus 5, we have total in 20 units. Invicta sold 7 units on 5th January. So 7 units, applying that logic, we have must have sold 5 from this opening stock and 2 from the first purchase, which was at $4. So whatever we have now 10 plus 3, 13 units in stock. So how can we value this? We have 3 units using FIFO, first in first out. We have 3 units at $3.5, $5, plus we have 5 units at 5 units at $5, and then 5 units at 5.5. If you calculate this, simply you will get the closing inventory. How much is that? $64.50. Or if you find easy, you can do it like this as well. Five units at 5 units at 5.5. So 3.5 5, how much is that? 12 into 3.5. 3 into how much is it? 3 into 3.5. So there is some mistake. Actually, I'll have to redo it because I did a mistake. Redo as redo. Okay, using this data, we'll be doing that, calculating this valuation using 3 methods. First, we'll go through FIFO. Assumption for FIFO, we know the oldest stock, oldest inventory will be utilized first. So 7 units sold, 20 we have total. 20 minus 7, we have 13 units in the inventory now. So the 13 units are from the most recent purchase. Most recent purchase this. So we have used 7 from this. So most recent purchase, we have 3 from this because 2 we have already sold. So 3 units at 4, then we have 5 units at 5, then we have 5 units at 5.5. If you add them up, you will get the closing inventory. Here you have 12, 25 and 5 into 5.5, 27.5. If you add them up, what will you get? 25 plus 12, 64.50. That is closing inventory. Through FIFO, we'll keep noting FIFO gives this value at 64.50. Let's go to the other method. So FIFO, simple. Let's go to the other method, that is periodic average. For periodic, we'll just add all these units at to the total cost of these units and just divide it. For instance, the total formula will be total cost over total quantity. So now, if you have scientific calculator, it will be much easier. 5 into 3.5 plus 5 into 4 plus 5 into 5 and then 5 at into 5.5. Now divide it by total units, which is 20. The total value of the purchases and opening stock, opening inventory, and divided by the total number of units. What will you get? Use calculator, don't depend on me. So this is 4.5. So cost per unit is $4.5 through this periodic average. Now the value of 13 units. 13 into 4.5, what is that? 13 into 4.5. Closing inventory is 58.50. That's your closing inventory through periodic average. So periodic, how much? 58.50. Okay, so this should be pretty clear. All purchases, whatever you have, opening stock and purchases, add the total value, divide it by the number of units. Simple. And you will get per unit rate, and then you can multiply it to the whatever quantity you have in the inventory, and you will get that. Now that this continuous average, bit different and lengthy, not this as simple as this is, but even that is not that difficult, but this one is little bit more needs systematic arrangement of data. So to handle it properly, you will make a schedule using a continuous average, weighted average. Date, transaction, and then cost per unit and total value. You will need these 4 items. Now, opening January, we had 5 units. So, 1st Jan, opening inventory. Units, I missed units. 5. Okay. Rate or 3.5. What is the total? Need calculator. 5 into 3.5. Total is 17.5. Hope you can read it. It's not under the light. 17.5. Then what happened on 2nd January? 2nd Jan purchase. Transaction is purchase. How many units? 5 units. At what rate? It was $4 each. And the total 20 total value. Okay, now We said in this continuous average, after each transaction you will have to update the per unit rate. For that, after each transaction you will add these two: total value and the number of units. How much is total value? 20 plus 17.5, 37.5, and units 10. By using this information you will get the updated rate here. How? Total value by total units. You will get per unit rate as 3.75. Okay, so that's after each transaction you will have to update the rate. Now what happened on 4th January? 4th Jan, purchase 5 units at what rate? 4th January, what rate? $5. 5 into 5, 25. Now another transaction, another purchase, meaning we need to update the rate. 37.5 plus 25. 37.5 plus 25, 62.5 total value. Now units 15. We know how to calculate the updated rate. 62.5 over 15. You will get that rate divided by 15. 4.1666, 4.17. That is our updated rate on 4th January after this transaction. Now 5th January, on 5th January there is no purchase, but there is a sale on 5th January. 5th January sale. How much? How many units? 7 units. We need to update the quantity as well. So 7 units. When we are calculating the cost, valuation of stock, we are not concerned with the selling price. They sold on $10, $20, forget it. From here we'll remove the related cost. Whatever cost we have in the system, in the record, we'll remove that cost only. So 7 units at, of course, this rate 4.77. It is 4.17. 4.17 into 7. We have $20. 29.19. We'll remove this cost because these units are gone. So let's update the value and the units. Rate we don't need to update because we sold on this rate. Already updated rate we have used for removing that cost. So there will not be any change in the per unit rate. So minus 62.5. So we have updated value is 33.31 and the units 8 on 5th January. What happened on 6th January? Again, there is some transaction on 6th January. Purchase. How many units? 5. At what rate? Very expensive. 5.5. So 5 into 5.5 is 27.5. Update. How much is the total value now? 27.5 plus 33.31. That's 60.81. And the total units, 8 plus 5, 13. Now 13 units, what is the per unit rate, updated per unit rate? Although we have already got that closing stock, we know at this date, closing date, we have 13 units and the total value of 13 units. That's our value of closing inventory. How much? 60.81. And that was continuous. Okay, but let's calculate the per unit rate as well, because that's easy and now it's not a big deal for us. Why don't we leave it? Why do we leave it? 60.81 divided by 13. 60.81 divided by 13. We get 4.67 per unit, and that's our value of closing inventory. Now, quickly, although I'm not that much concerned with the second part, this was the main objective for all this SL, but quickly we will go through the second part as well, because that's not difficult. This continuous average. After each transaction, purchase on 2nd January, we added the units, we added the total value, divided the total value divided by total units, we will get the updated rate on 2nd January. Then on 4th January, we had another purchase. We purchased 5 units at 5, added their value to the balance we had before that, and we got 62.5, divided it with the total quantity of inventory, 15 units, and we got that rate. That's how we calculated the updated rate after each transaction. Now they are asking us to calculate the profit using these 3 methods. Now, for this gross profit calculation, opening, we need, what do we need? We need sales. Then we need keep the sales here so that I have some space for some calculations. That's why she has given this information. The book has already given this information. Invicta sold 7 units at $10. 7 into 10. How much is that? Sale is $70. Okay. Now we learned in the first part how to prepare that, how to get that cost of sales. Opening inventory. Opening inventory. How much is opening inventory? 5 units at 3.5. 17.5, I believe. Purchases. Purchases 15 units at different rates. Okay. But if we want to calculate how much, how we'll calculate this, like 5, 5 into 4 plus 5 into 5 plus 5 into 5.5. How much is that? We'll get this 72.5. Is that correct? $72.5. Now, if you are asked to use FIFO, you have that closing inventory deducted from the here closing inventory 64.50. You will get your gross profit. If you are asked for a periodic, just use this closing inventory, and for continuous 60.81. Only that figure will change. In all three methods, opening inventory and the cost of purchases, this is about, if you add 90, that opening plus purchases $90 will stay the same. Only the difference will be this valuation of inventory. So if you calculate this, 17.5 plus 72.50 plus 64.50. That's your cost of sales, $25.5. Cost of sales using FIFO. FIFO, because this valuation is based on the FIFO method. Okay. Now deduct it from 70. You have profit of 44.5 gross profit. Using different methods will change this value, and depending on this value of closing inventory, gross profit will also be slightly changed depending on the valuations. So that's why they are given different methods, but the basic structure will be the same. Only you will change this, and this statement will be according to the next method. Hope this has helped, and it needs practice. Go through this stuff as many times as possible and get ready, because these things are not that difficult. But if you have time in exam, you will not have that much time. You have to manage it very quickly, because they will ask it in a multiple choice questions. Thanks a lot for watching this video, and if you have any questions, do ask me in the comments. Thanks a lot.